Next up, we have Andy Hoonfeld. I know I said that wrong, but way wrong. But Andy's part of the Connect team. You might be getting some messages from him on a regular basis on market updates, and that's what he's here to share a little bit with us today, is some insight on the markets. And Andy.
Thanks, Phil. Good morning, everybody. My name is Andy Hunefeld with Connect. My role with the company is kind of twofold. Number one, I'm in charge of leading the effort of kind of forming the company's opinion on where we think the energy markets are going and communicating that opinion and updates out to our client base and out to our internal personnel so they can then use that information for their clients. The second part of that is what I want to lead off with, actually, is what you do with that information is different for every single customer. And one of the things that we provide for our clients is some strategic planning, some risk management planning to chart a path forward. Energy markets are unpredictable. We try our best to predict them, and sometimes we do a pretty good job at it, but there's always these external factors that can come up that nobody sees coming. And it's very important for your business to have an actionable plan that you stick to, that is aligned with your goals and objectives of your business. Are you budget driven? Are you long-term oriented? These are the types of questions we ask our customers to help find the best plan for them, for both their natural gas and electricity, and really any kind of energy you use. And really what we shoot for when we develop those plans is to strike a proper balance between how much uncertainty and how much certainty your business needs as far as your energy costs. And I'll tell a quick story before we get into the market stuff to kind of illustrate this. And this is an extreme example, but it's something that is real world and it happened within the past year. Currently talking to a company in the Pacific Northwest, a large paper mill, and they had a guy that was managing their energy expenses. And he was waiting for a $2.40 price for the winter. He had about 20% of his natural gas coverage locked. Gets to October, on the eve of winter, and he's trying to get an extra 5 cents or so out of the marketplace. 2 days later, before he was able to do anything, a pipeline exploded in British Columbia. So 80% of his natural gas spend, because he was chasing that extra nickel, suddenly was subject to $60 to $100 per MMBTU pricing, and he was hoping to get it down from $2.45 to $2.40. Now, nobody could have predicted that pipeline explosion, obviously, but the key is here he had a plan to try to get up to 80% of his usage fixed. And he kind of punted that plan down the road a little bit because he was chasing that extra dime, that extra nickel. So I guess the key takeaway for this is that energy prices are low, natural gas is abundant, but that doesn't mean there's no risk out there. And even in normal course of business, which we'll talk about, without the pipeline explosion, there's still major risk, major factors that can lead to a lot of volatility in your costs. And it's very important to get out ahead of that and to manage these costs, especially because right now when we look out into the future, we see probably the most favorable environment for long-term energy purchases that we've ever seen in the United States. And I think it's prudent for everybody to do at least a little bit to take advantage of that. So now that we got that out of the way, our agenda. We'll start regionally, talk about some of the dynamics that are impacting prices here in Pennsylvania, across the PJM territory, and then we'll get national. We do see natural gas fundamentals tightening, which sounds weird to say because all you hear about is how fast production is growing, which is true. Production has grown a lot in the past decade. It's one of the main reasons why energy prices have been low. It's one of the main reasons why we're having these discussions that we're having right now. But again, abundance does not remove risk. And we just saw that illustrated in a big way to start the winter of 2018, which we'll get into. And then again, risks and opportunities going forward. What's the landscape for the rest of this year and beyond? Where do those opportunities lie? And we do see a lot of opportunity in this current marketplace. So start off with something that everybody in the room is very familiar with. This is Marcellus and Utica natural gas production. We went in this area from producing about 3 billion cubic feet per day as recently as 2010 to now producing about 28 billion cubic feet per day in 2018. That's 1,000% increase. About 1/3 of every BCF of natural gas that gets produced across the United States comes from the Appalachian region, the Marcellus and Utica shale. So what does this do for local prices? Of course, it makes them come down. So from 2010 to 2016, we saw average pricing, and this is Dominion South, which is the hub that we'll use for talking about regional natural gas prices. We saw regional pricing collapse, culminating in 2015 and 2016, where we had 2 years of average delivered natural gas pricing at $1.50. And of course, that's driven by, see that catch, by producers flooding the area with natural gas with not a lot of takeaway infrastructure. So every new BCF, every new molecule that was produced, it was trapped in a very, very limited regional area. Well, of course, there's going to be investment that comes in to try to change that. So we started to see that really coming to fruition in 2017 and especially in 2018. Between 15 and 16, we saw production in the Marcellus go up about 24%. We saw price at Dominion South go up 60%. From the 2 year period 15 to 16 to the 2 year period 17 to 18. Basis differentials, when we look at Dominion South versus NYMEX, so NYMEX pricing was up. NYMEX is the national benchmark deliverable at Henry Hub, and most natural gas contracts that you see across the country are still going to be based on that. There was some talk about maybe moving that hub to someplace in the Marcellus a few years ago, probably going to stay at Henry Hub, for better or worse, even though that's some of the most expensive gas in the country right now. But we saw the differential go from about $1 plus discount in 2015 to last year only a 45-cent discount. So we're still cheap up here. We're still cheaper than NYMEX, but we're seeing that squeezed. And the reason we're seeing that squeezed is because we're moving gas out of the region right now. We saw 2 major pipelines, Rover and Nexus, that are designed to bring gas from the Marcellus into the Midwest. Both of those came online over about a course of about 18 months from 2017 to 2018. That's 5 billion cubic feet per day. We've seen the Atlantic Express pipeline, which is designed to bring gas down south, about 2 BCF per day. We've got some pipelines going to the East Coast, about 4 BCF per day, and 1 under construction right now, or 2 under construction, the total about 2 billion cubic feet per day. So overall, we're talking about 13 to 15 BCF per day out of this 28 BCF per day, so not insignificant portion, is now available to move into areas that it was not previously available to move. The one area, as mentioned before, that's not seeing the benefit of this is the Northeast. Most of the pipelines that have been planned to go up into the Northeast, to go to places like Boston, where they've got incredibly expensive natural gas, very constrained pipeline infrastructure, are having a lot of trouble getting off the ground because of the not in my backyard, because of a lot of environmental concerns politically in that part of the country. But there's plenty of outlets for it in the Midwest and down south, especially as we start to add more and more of this LNG export infrastructure. So this has changed the game a little bit here. I think that when we look back at the world we had in 2015 and 2016 with the sub $2 per MMBTU gas prices that translate to power prices as well, which we'll get to, I don't think that we can expect that to stick around. Our prices are low right now, and there's the opportunity to lock in low prices long term. But from here on, chances are any incremental increase in Marcellus production is not going to go to benefit local consumers. It's going to go elsewhere in the country. Producers aren't excited about drilling and producing $1.50 per MMBTU natural gas. They're looking to send that out to more higher price markets, and we're seeing that develop right now. So this has been talked about a lot, so I'm not going to spend too much time on this, but this is the PJM ISO generation mix, and I'm focusing on coal and natural gas. There's other shifts, but they're fairly minor in relation to what we've seen happen in coal versus natural gas since the beginning of the decade. Natural gas in 2010 accounted for 15% of every megawatt hour generated in the PJM territory. Coal was 50%, which was about the national average. Now, in 2018, we've seen natural gas's share of this mix double. 30% of all megawatt hours generated actually overtook coal in 2018. Coal was only 29%. So what this does is a couple of different things. Natural gas has always been the peaking fuel. It's always been kind of what sets the price on the margin. Natural gas is now becoming more of a baseload fuel, so it has a greater impact on the overall electricity cost. And when we look at the shape of the current forward curve, when we look at where historical prices have been, we do see a very strong relationship between delivered natural gas at Dominion South, or even NYMEX if you look at it directionally, and power at PJM West and across the rest of the ISO. So this is what the Dominion South forward curve looks like. We went from $1.50 in 2016 to $2.13 in 2017 to $2.66 in 2018. Now we got a backward sloping forward curve. A lot of people might look at this and say, well, what do I need to worry about? The market's pricing in, or the market thinks that prices are going to go lower. Really what this is showing is that the market is pricing in a best case scenario. If natural gas is abundant, if supply continues to outpace demand, maybe this is what the actual market looks like. What we've actually seen observed is a little bit different. 2018, for instance, was trading at a discount to 2017. It ended up pushing higher. And as these months come closer, and we're already seeing this with 2020, as these months come closer to the forefront, we're seeing prices come up, not go down. Instead of that risk premium that you used to have to pay for long-term hedges, now you get a discount. We encourage people to take advantage of that discount. This translates to PJM West as well. The price movements are a little bit more extreme here, but you still see that backward slope from 20 to 21 to 22, and then you start to go up a little bit in 2023. Long-term opportunity in both natural gas and power. Any risk to the upside for natural gas translates to power. Any downside opportunity for natural gas would also translate to power, but our opinion right now and my thesis for today is that that downside opportunity might be very limited unless you just want to roll the dice and hope that weather doesn't show up. And I do want to encourage anybody, if they have any questions throughout the presentation, don't feel like you have to wait to the end. Put Phil to work a little bit, raise your hand, he'll throw a speaker at you, and you can ask questions as we go on. So real quick, I'm going to broaden things out. Instead of talking about just what's going on here locally in PJM, let's talk about the national market, because we are seeing a lot of shifts in what's going on a macro level, which also has a carryover effect into this area in PJM. Natural gas does look like it's headed higher into the summer. I strongly believe that we traded a seasonal bottom in April, and prices are going up, and that, again, translates into power as well. Inventories, which are a big driver of where we see prices going, have improved, but they're still lower than average, and there's still potentially some issues, which we'll talk about as we move through the year. Because domestic production growth, while we're still churning out a lot more gas than we did 12 months ago, it's actually been flat for about 6 months now. And that year-over-year change that's led to a lot of perceived bearishness, perceived weight on prices, is going to start narrowing right about the same time that demand is going up. We expect to add a lot of new export capacity in 2019, and we're already seeing some of that come to fruition. Meanwhile, generation demand and industrial demand have been trending up for years, and we see that trend continuing this year and beyond. So I want to start with a story about 2018. So show of hands, how many people know that the U.S. in 2018 produced a record volume of natural gas? Few people. So not only did we produce a record volume, we beat the previous all-time record by over 10%. So we blew it out of the water. Averaged just under 81 billion cubic feet per day. So how many of those same people knew that even though we had record supply, we actually came into this past winter with the lowest volume of natural gas stocked away in 15 years, since 2003. So a couple people up on the market. So the question is kind of, where did all that gas go? We had record production, and we ended up inventories, the blue line, if you can see it, way below the 5-year range, actually at the lowest level since all the way back in 2003. So all that excess volume goes into generation units. It goes to industrial facilities. It goes to export terminals to be shipped overseas. So I guess the key message here, and what I want everybody to go home with, is that even though production is growing, and it's growing very fast, or at least it was up until about November, demand is largely keeping up in the U.S., and it led to some real problems coming into the winter of last year. We saw extreme volatility starting in about November. This was kind of a slow-moving car crash that we were watching all summer. We saw what trajectory inventories were on. We saw where we were very likely to end up, and the market largely ignored it until it smacked them in the face. And in November, we started to see prices shoot up. And this is NYMEX natural gas. It went from sub $3 levels to start September up to as high as $4.90 at one point during the first week in November. We had wild swings in the market that we hadn't seen in about 5 or 6 years, last pretty much through January. Dominion South, we saw prices up well over $4 per MMBTU for weeks at a time. We saw PJM Power averaging over $40 per megawatt hour, as high as $70 or $80 per megawatt hour for given days. So low inventories heading into the winter led to a great deal of market volatility. Now we've seen things settle down a little bit. Storage has improved. We got bailed out a little bit. We had a very mild stretch from about the first week of December through the third week of January. Things got cold again late February, early March, and we had some lingering heating load up north. But for the most part, we got bailed out. It was overall, if you look at averages on a population-weighted basis, a fairly tame winter, just a little bit cooler than normal. April was especially mild across the country, and we set all-time records as far as how much gas was added to storage inventories throughout that month. So had an issue coming into the winter. Weather helped out a little bit. Production helped out a lot. And sitting here in late May, inventories are improved, but they're still not in great shape. We're above last year, still south of the 5-year average, on a very sharp trajectory so far, but we've got some real questions on whether this trajectory can continue and get us to a healthy level going into the winter. And that's one of the key risks I want everybody to recognize as we see cooling load ramping up. We get into this riskier summer period. A lot of times we get trapped into a kind of a way of thinking that you see prices come down in the spring, go up in the summer, and come back down in the fall. And yeah, that's a typical pattern that you do see across all energy markets. But I'm concerned that by the time we get into the fall, this market is going to look a lot tighter fundamentally, and that move back down might not be as dramatic as a lot of people are hoping. So prices look good right now, and we are encouraging most of our customers to be looking at locking in at least into next winter and probably beyond, depending on your risk strategy. So domestic production, we've already talked about this at length, but this is the trajectory of production just over the past 2.5 years. We've gone from sub 70 BCF per day in 2017 to nearly 88 BCF per day. And this depends on the data source, exactly where these numbers land, but the trajectory is more or less the same. However, that rapid growth that we had from the beginning of 18 to the end of 18 does not look like it's repeating itself this year. We're not adding as much infrastructure. So all of this pipeline capacity that's come online in the past 2 years, the gains from here are a little bit more incremental. So we can't expect rapid growth out of the Marcellus and Utica to make its way into the broad market this year. Additionally, if you go down into the Southwest, the Permian Basin, has anybody heard how low prices have gotten at some of those points down in West Texas? They're paying to get rid of it. So you talk about negative pricing, people are like, oh yeah, like negative basis, like it's a discount to NYMEX. No, negative pricing. Essentially what's happened is with this flood of new crude oil production in West Texas, it comes with associated natural gas. So the gas isn't the primary economic driver of the drilling. It's kind of icing on the cake typically. They maxed out infrastructure, and we had a couple of compression stations go down unexpectedly at the beginning of April. And places like Waha and El Paso Permian got as low on a single day as negative $6 per MMBTU, which means that every decatherm that you burned, you got $6 in return for it. I think that's unprecedented for it to get that low. Actually, Waha settled negative for the entire month of May, and right now it's trading negative for the entire month of June. So what I'm getting at here is that we can't expect a lot of new natural gas production until we get new pipes out of the Permian Basin. There's some hope down in Mexico that maybe some distribution infrastructure finally comes online and we start to see El Paso exporting into Mexico. That could relieve prices and end up increasing our domestic production. But again, it's not for our benefit, it's going into Mexico. We talked about some of the issues with the new administration there. Essentially, the opening up of the gas and power markets in Mexico is grinded to a halt. So I don't know if that's a viable outlet for that West Texas gas. There are 2 pipes, maybe more, in the works, depending on how things go, that are going to come east across Texas toward the Gulf Coast. That will potentially relieve some of those constraints, allow for some more domestic production that right now we're not probably going to get from the Permian Basin. But why is that gas going to the Gulf Coast? It's not to service Gulf Coast end users, it's to fuel LNG exports. So we're at a point in the Permian Basin, at least, which was a source of a lot of this growth in 2018, where any incremental gain, not dissimilar to what we're seeing here in Pennsylvania, any incremental gain in production in the Permian Basin is either going to Mexico or into a liquefied natural gas terminal. So there's avenues for growth. They've dried up a little bit in 19. That's why we're seeing this trajectory flatten out. And when those avenues open up, it's very, very likely not going to be of a big benefit to domestic consumers. So what we're looking at here is the blue area is the 2018 January through December production growth. Very consistent, very sharp. So far in 2019, we have grown, but closer to a half to 1 BCF per day. Trajectory is a lot lighter. Meanwhile, we're adding a lot of demand in 19. So this year-over-year gap that's allowing us to build storage right now at a pace that's so much faster than 2018 is closing. And for the second half of summer at least, and I keep hitting this microphone, for the second half of summer at least, we expect to see the trajectory of storage inventory growth to look a lot like it did last year and to not be building this big surplus to year ago storage. So that's something to keep in mind as we work through the year. Meanwhile, as we mentioned before, demand is growing. We've seen since 2009 very consistent increases in the amount of natural gas that's burned by industrial plants. This is part of overall economic growth that we've seen since that recession, but it's also due to the competitive advantage. The U.S. has some of the cheapest energy prices in the industrialized world, so there's a lot of very energy-intensive processes, fertilizer plants. I drove past the giant ethanol cracker on the way in to the course today being built off of one of the expressways. So we're seeing more of those facilities that are being onshored rather than built in developing countries. That's leading to increases in consumption. Generation load, we've talked about this at length already, but as years go by, we see nothing but older coal units retiring or reaching the end of their life cycle. That demand is being backfilled by natural gas generation capacity. When we look at future additions and takeaways from the generation mix, still favoring natural gas. There's not really any large-scale new coal generation being planned right now. Those additions across PJM and across the rest of the U.S. Maybe save the West Coast where they're already moving off of natural gas and more onto renewables, favoring gas. So we expect this consumption to continue higher. We're projecting about 2 billion cubic feet per day of increased domestic consumption from these two sources over and above what we saw in 2018. So that's gas that last year would have been available to put into storage. This year it's going to an industrial facility or into a combined cycle turbine. And this is the big one. This is the biggest sea change that we've seen really probably in any energy market in the past 25 years. And this is the shift from a major net importer of energy, and we'll talk specifically about natural gas, to becoming a growing net exporter. As recently as 2009 and 2010, the U.S. was a net importer of around 7 to 8 BCF per day of natural gas. In 2017, that switch flipped. We were a net exporter of a small volume for the first time. In 2019, when we look at a reduction in pipeline imports from Canada, steadily trending higher pipeline exports to Mexico, although some of those projections might have to be taken in a little bit for the long term, not necessarily for 19, but mainly the shift from, at one point, 10 years ago, 11 years ago, we were investing hundreds of millions and billions of dollars in infrastructure to import liquefied natural gas. Now that switch has flipped the other way, and we're converting those terminals to export terminals. And we expect in 2019 to be a net exporter of about 6 to 8 BCF per day. That's an increase of 4 BCF per day over and above 2019. So when we look at this big increase in production, where is that extra gas going? Is it going into storage, or is it going to industrial facilities, to generation facilities, and for the most part to new export capacity? New production doesn't mean that prices are going to collapse. It means that we need that production to keep up with all of this demand. So I want to talk for a little bit about liquefied natural gas exports and what this landscape looks like out of the U.S. Right now, as we speak, we have 3 large-scale terminals online. The first one came online in 2016. Sabine Pass beat everybody to the market by over 2 years. Sabine Pass now has 5 separate liquefaction trains, and they're planning more. The second terminal that came online in early 2018 was Cove Point. That's on the East Coast in Maryland. That's been operating at capacity ever since. Recently, we added Corpus Christi, and we're on the verge of adding Freeport and Cameron in 2019 and 2020. So we've seen a demand sector, which was literally nothing in December of 2015. By the time we get into the first quarter of 2020, we could be up to 9 to 10 BCF per day. More than 10% of overall production is going to be available to export. Now, the question is, yeah, we've got this capacity online. Global prices are down. Will these export facilities actually operate at capacity? The answer so far has been yes. As new LNG terminals have come online, for the most part, they've been fully operational and operating at or near their capacity. The reason is, and we expect the same for the new terminals coming online, these were built on the premise of very firm, very friendly to the terminal, 20-year, basically take-or-pay contracts. So the off-takers, which are typically going to be global marketers that are destination flexible, and that's key, these volumes are not tied to a specific port. If they decide not to take the volume because of economics or whatever reason, they still have to pay for the liquefaction and the shipping. So it's not quite as simple of a calculation as price at Henry Hub plus liquefaction plus shipping, price in the UK or in South Korea. There's a little bit more to it, and the off-takers that have signed these long-term deals have an incentive to make them happen. So as this capacity ramps up, we do expect it to be executed on, and we expect LNG export demand to reach 9 to 10 BCF per day by mid-2020, with most of that coming online by the end of 2019. This is a big deal. It's a big demand increase, and it connects the U.S. more and North America more to the global marketplace. We've been isolated for a long time. The more this capacity comes online, the more the external factors like geopolitics could start having an impact on our natural gas and electricity prices in the U.S. So the question that I've gotten more times than I can count over the past several months is, what about China? Got this escalating trade war. We're trading tariffs back and forth, and recently China did slap a tariff on U.S.-sourced LNG. What impact could this have? What impact will this have? My contention, and this is just my take, I think that the numbers back it up, is that it will not have an impact on the current marketplace. It could have an impact in 5 years, but we'll get to that. So this is the list of countries. I know the text is small. The U.S. exported LNG to 30 different nations in 2018. China was the 4th largest importer of these volumes at about a little over 0.2 of a BCF per day. So number one, the volume is small. Over the course of a year, that equates to like 90 BCF, which is a mild winter day of demand. So not insignificant, but not terribly significant either. But more importantly, and this is what we've seen demonstrated so far in 2019, this is data that runs 3 months into the year from the DOE. We have seen China reduce imports. They've gone from about 0.25 BCF per day to about 0.08 BCF per day. So we've seen those volumes come down. Instead of the 4th largest importer of U.S. sourced LNG, China's now, it looks like, the 15th largest importer of U.S. sourced LNG. So at the same time, we have not seen volumes come down. The contrary, we've seen volumes go up. We've seen all of our facilities operating in capacity. So I think that the most important thing to consider when looking at the U.S.-China trade war is that our volumes are very destination flexible. If China doesn't want them, there are other nations that do. And this is why I don't see this as a big impact on the current market. Where it does cast a shadow of uncertainty is in the next wave of potential LNG exports that we look at in 2024, maybe 2025. They've been a little bit hesitant to pull the trigger and make the final investment decision and break ground, even though they have full government approval because of some of this global trade uncertainty, but mainly because those sweetheart 20-year deals that all these terminals were built on are no longer available. I think that the LNG marketers, the off-takers, realized that this wasn't a great agreement, and they're looking for a little bit more flexibility for the next wave. But I guess the key here is that the situation with China unlikely to have a big impact on our energy prices, or at least natural gas prices in the U.S., but down the road could lead to maybe one or two terminals that otherwise would have been built, maybe not coming online. It's more of a long-term issue than a short-term issue. So get into some projections here. When we look at our expectations for ongoing production growth for the rest of the year, expectations more importantly probably for demand growth, for export growth, we see storage inventories improved continuously in 2019, but only getting up to about 3.6 TCF. What does that mean? Better than last year, so maybe not quite as much trepidation going into the winter with extremely low inventories, but still not even up to the 5-year average. And if you assume that the natural gas winter is about 180 days, 170 days, 150, I guess, sorry. If we're exporting an extra 3 BCF per day, all of those days throughout the winter, that's 450 BCF of storage. That starts to normalize this pretty quickly and bring it down to about where we came in last year. So 3.6 TCF is not a terrible number for the end of the summer, but it's also not an incredibly healthy number when we look at everything that's going on in supply and demand. There is a lot of uncertainty still, and a lot of that comes down to weather. We haven't talked about that yet, and I'm not going to spend a lot of time on it because weather is a big variable that does impact demand, it does impact price, but it's unfortunately very unpredictable. At the moment, the consensus for the summer is a little bit warmer than normal, but actually cooler than last year. Enhanced upside risk for heat in this part of the country, so maybe that leads to some more volatility at PJM, West and at some of the hubs for natural gas across this area. But overall, right now, expectations are for a pretty tame summer, which is what we have baked into our expected case forecast here. If we deviate much from this one way or another, there's a situation where we could be teeming with natural gas. There's a situation where we could be in a very similar state that we were in November of 2018. So more uncertainty than certainty at this point, but this is our projection right now, 3.6 TCF. So wanted to show what the forward curve looked like and use 2016 as an example. When we look back at recent history, 2016 is a good candidate for about as good as it can get for energy prices. We didn't have a winter, basically 15-16. It didn't show up. We saw the price of NYMEX natural gas collapse. We saw delivered natural gas collapse. We saw very low power prices across the country, and the market suffered for it. Production economics took a big hit. We had a lot of producers that almost went bankrupt in 2016 because they were having trouble servicing their debt and keeping the lights on. We saw power generators really move to take advantage of that cheap gas. Even the less efficient guys that were built for peaking purposes were able to compete with coal in the day-ahead markets when gas prices got so low. So we saw consumption really increase. And for a calendar year in 2016, NYMEX natural gas averaged $2.46. When we look out across the long-term forward curve, we've got 2020 at 273, 21 at 265, 22 at 263. So we're a lot closer to kind of that demonstrated floor than we are to even where prices have been over the past 2 years. And these are NYMEX pricing, so don't get hung up on the numbers themselves. But I guess the message is that across the board, whether we're talking about natural gas or electricity, in most of the country, including PJM, we're a lot closer to that potential downside long term than we are to where prices could go if production growth continues to stall, as demand continues to rise. If we have some unforeseen circumstances that influence prices to the upside. So this is why we're big proponents of that long-term planning right now, because you can get a discount by going out long-term, and you can lock in prices that are very close to as low as they've been. So before I wrap up, and about 5 minutes early actually, key takeaways: low prices do not mean the risk is gone. Abundance does not mean risk is gone. We saw just 6 months ago in November, the market go absolutely crazy following a year of record production. So don't get complacent just because you read that natural gas prices are low. Long-term buying is very advantageous, but how long-term and how covered up you get depends entirely on the nature of your business and what your long-term capital plan is. We'd be glad to work with anybody in here at developing that plan and to managing that risk on an ongoing basis. It's key to have that risk management strategy tailored not to what the market is doing, that's important, but tailored to your business's goals and objectives. And that is all I've got for you today, unless anybody has questions for me.
Any questions for Andy?
For real? All right. So if you already have a 3 to 5 year contract in place and it might carry you out till 2020, 2021, how soon do you begin to start to develop your strategy for a plan to follow that period?
That's a tough question. It sounds like you've done good planning and taken advantage of what the current discount. You do start to see prices sloping up beyond that time frame. I would wait maybe to get a little bit more clarity about what the future of that LNG export situation looks like. I think that we might see that as the trade dispute is gradually resolved. But even when you go out to the second half of the decade, prices still look really attractive. And I think it does depend on what you're going for. It sounds like long-term certainty is a premium for your business for planning purposes. So, I mean, I would think about kind of extending that maybe a year at a time, watch the market, watch for some seasonality, and try to squeeze some value out. Long term, you can afford to be a little bit more aggressive, but I would look at it on an ongoing basis and think about extending it in the next 3 to 6 months even.
Just for the record, our then on-demand energy team, now Connect, locked us in 2016. Kudos, guys. Great job.
Yeah.
Thank you.
Great job, everybody.
Andy, one last question.
Hey, Carl.
Hey, so Carl Renninger with Connect. So North America or U.S., we've been very isolated historically with natural gas prices. It's been a self-contained market. Folks like you and others in the world of risk management have built models, make assumptions based on that. As this LNG export continues to grow, when do you really see it disrupting kind of our models and our opinions? We're all used to the shoulder months and pricing moving in that direction. Is there a certain level at which those geopolitical and global markets will really start to change the way we look at and model and expect prices to move over the course of a year?
I don't know if there's a drop dead date or a volume where you would see those fly out the window. I think as long as things are kind of quote unquote business as usual, those same domestic ways of looking at the market are still mostly valid. But what it does is, you know, we had that big event up in the Pacific Northwest with the pipeline explosion. The more we open up our gas to the globe, the more it opens up unexpected risks into the marketplace. So the perfect example was in 2011 when Fukushima disaster happened in Japan. And we saw Japan-Korea marker, which is the Asian LNG benchmark, went up from about $9 to over $20 per MMBTU for a while. It wasn't just an immediate spike because suddenly Japan wasn't using nuclear power anymore. It was all natural gas. At the time, we didn't have any connectivity to that. We didn't have exposure to it on the import side. We didn't have exposure to it on the export side. If that happened today, or especially next year when over 10% of our production could go overseas, I think it could have a big impact, and it could kickstart some of this new capacity and get it rolling. At the moment, we're using all of our capacity, so whether prices overseas are $10 or $20, it doesn't really have a big impact on demand. But the more we build that out and the more flexibility there is, the more maybe idle capacity we end up building, maybe in the middle of the decade, that's when I think that you're really connected to the global space and those geopolitical events can start to have a big impact. Yep.
Any last questions for Andy? Jim?
Yeah, where do you see capacity and transmission costs going in the near future for PJM?
This might be a question for one of our friends at On Demand. I know capacity in recent auctions. What? Oh, sorry. One of the legacy On Demand. I know capacity auctions, and somebody can correct me if I'm wrong on this. I'm not in this every day, but those prices have come down pretty considerably in recent auctions as more demand response enters in and things like that. I don't necessarily see that changing. When you look at the long-term planning at PJM, it does not seem like we're going to run into any major issues on the capacity side. The transmission side, I'm sorry, I don't have a firm answer for you on that. I assume it'll go up, because I think transmission costs tend to always go up, but I don't have any nuance to that opinion.
Anything else? Thanks, Andy.
Thanks, everybody.
You want to cue the video?